Before delving into why this statement will ring true for 2024, let's establish a mantra. Amidst predictions of bear market or bull market, both will miss the mark this year. In 2024, success will hinge on stock selection, with most gains driven by a select few mega capitalized companies. If you find yourself in those companies or sectors, you're poised for a good year. Notably, last year's significant gains were elusive for those not invested in the Magnificent Seven. This year will definitely be a more difficult year than last year. The reason, if you thought last year was a very selective year in seven stocks, it will be even more selective this year. The prediction still for the major averages to be up this year, but many people who are selecting in the wrong sectors and the wrong individual stocks will have subpar to maybe even losing years this year. If you follow our recommendations the last few weeks, investing in companies like Nvidia, Amazon, Meta, etc., you were greatly rewarded. It all boils down to stock selection, and this week will be no different. Last year, we were very bullish in 2023. In 2022, we were very bearish. The answer this year is pick the right stocks. What is your process in picking the right securities, the right sectors, what you are investing in? When venturing into the stock market, it's crucial to choose a process that resonates with your preferences and aligns with your investment goals. Then commit to investing in it. For me, my investment strategy is grounded in consistent weight of evidence, rule-based, top-down approach, leveraging analytics, data-driven insights, and technical analysis. I operate across various time frames, including short, medium, and long term, always emphasizing risk management in my trades and investments. The foundation of my approach is a rule-based system which imposes a disciplined methodology, eliminating emotional decision-making and impulsive actions. Rule-based investing involves a set of strict guidelines employing if-then rules based on a series of predefined criteria. This systematic approach helps me make informed decisions without succumbing to emotional reactions, ensuring a more calculated and strategic investment process. In the current market landscape, I identified two major concerns. Firstly, there is a prevailing sense of complacency where individuals may not be adequately factoring in the downside risks of the stock market. This complacency is evident as people continue to buy on the dips, similar to trends observed in 2023 and the beginning of 2024. We did the same thing and we were greatly rewarded. This year will be a little bit different. Secondly, there is a growing euphoria fueled by trends in electrical vehicles, cryptocurrency, and artificial intelligence, AI. While these sectors show immense promise, history has shown that not every company involved in the revolutionary booms will stand the test of time. Many companies from past technology booms have eventually faded away. For instance, during the internet revolution, only a few companies survived the test of time. The same pattern emerged in the automobile, computer, and electrical vehicle industries. Now, AI is a new buzzword, and although it will undoubtedly continue to transform our lives, only a selected few companies will likely endure in the long run. The overarching issue in the current market is the prevalence of euphoria, and it's crucial to approach these trends with a discerning eye. My strategy involves navigating through these market dynamics with a disciplined, rule-based system, staying vigilant against complacency and euphoria. It's not just about participating in the revolution, but carefully selecting the companies that will withstand the test of time in these transformative industries. Despite acknowledging two major concerns in the market, we maintain our belief that the overall market will see positive growth this year. However, it will be a highly selective market with only a few securities and industries driving the positive momentum. This year is shaping up to be a stock pickers market where specific companies, particularly mega cap, heavily weighted in the NASDAQ 100 and the S&P 500, will exhibit remarkable gains. Last week's performance illustrated this point with companies we've recommended for over a year still leading the market, including Meta, Nvidia, Amazon, and others. To achieve stellar performance, being highly selected in the stock choice is crucial. While some predict the continuation of the bull market and others anticipate the start of a new bear market, the reality is a bit more nuanced. The key is to pick selectively among stocks for a successful investment strategy. We told you there were two problems with the market: complacency and euphoria. Both of these problems will be seen from sentiment indicators. A sentiment indicator is designed to represent how a group feels about the market or economy. These market psychology-based indicators attempt to quantify sentiment in the form of figures or graphically to predict how current beliefs and positions may affect future market behavior. Sentiment indicators look how bullish or bearish market factors and what they are thinking and feeling, which may help forecast investors' futures behavior. When sentiment readings are unusual, high or low, they may begin acting in a contrary way. For example, when investors are extremely bearish, that is often a contrary signal to sentiment indicator traders that market price could start heading higher soon. The general public, and usually people, are wrong. When many investors or pundits tell you to buy low, you should look at sentiment indicators, which will give you the indication that we are at the bottom. AAII Investor Sentiment Survey Bull and Bear Ratio, sometimes known as the bull-bear spread, is a market sentiment indicator published weekly by the financial data provider AAII, which uses information pulled directly from market professionals. Information is taken from investment advisors who work directly with general investment public to help them with financial planning and investment portfolios. The key takeaways is the bull-bear ratio is an economic indicator that tracks market sentiment by surveying professional financial advisors. The indicator is published weekly by the financial data firm AAII. If the ratio is greater than 1, there's a greater bullish sentiment since more advisors expect the market to rise, and bearish if the ratio is less than 1. If we look at the current AAII, it is a bullish forecast at 49.1%, where the bearish reading is 24.5%, and the neutral reading is 26.4%. If you look at the last few weeks, we are hovering at close to 50% of people believe this market is going up higher. This is above historical views. What I have seen, this indicator works very well, but sometimes it may take a month, 2 months, or even 3 months to see the top of this market. But we are building what we call a weight of evidence on investor sentiment indicators. But definitely, AAII is screaming a bullish indication from its advisors, which means they are usually always wrong. And this is why we're saying there's complacency and euphoria inside this market. The next one, Nova-Ursa ratio, called the Rydex index ratio. The Nova-Ursa ratio is an equity market sentiment indicator based on the bullish Nova and the bearish Ursa funds from the Rydex fund group. The Nova fund seeks to provide investment returns that match before fees and expenses of 150% of the daily performance of the S&P 500 index. The Ursa fund is an inverse fund that tracks the S&P index in reverse on a 1-to-1 basis. The relative amounts of assets in each fund to one another can be used as a proxy for the direction of the market sentiment. More specifically, a high value represents an overall bullish sentiment, and a low value represents a bearish sentiment. Key takeaway, the Nova-Ursa ratio is a market direction sentiment indicator that uses a Rydex mutual fund as a numerator and another as a denominator. The Rydex Nova fund is a bullish strategy, while the Rydex Ursa fund is a bearish strategy. As the assets move in and out of these funds on a relative basis, it can serve as a proxy of investor sentiment. How the Nova-Ursa ratio works. The Rydex Nova fund is a bullish with a target beta of 1.5, meaning the underlying securities within the fund tend to move more than the overall market. This can be a positive when the market is climbing and lead to an extra gains for the holders of these stocks. The Rydex Ursa fund is a bearish with a target beta of 1.0. This means the underlying securities within this fund tend to move less than the overall market. When the market falls, this can lead to softened losses for investors. If we took a look at the Rydex fund's Nova-Ursa ratio sentiment indicator, every time it hits extreme levels on the top side, we sell off in the market, and every time we hit extreme levels on the low side, we buy into the market, combined with other indicators. The next sentiment indicator is the put-call ratio. Traders generally use the put-call ratio as a contrarian indicator when the values go to extreme high levels or low levels. What this implies is traders consider a high put-call ratio of, say, 1.4 a great opportunity for buying because they believe the market sentiment is extremely bearish and will soon adjust when those having short positions switch places to cover the market will eventually face a downturn. extreme. We like to look at the extreme levels in these indicators. And when it hits extremes, combined with the two other indicators we told you previously, there is a high probability chance you are either getting on the bottom of the market or the tops of the market. There's no specific number that indicates the market has created a bottom or a top, but traders generally anticipate this by looking for jumps in the ratio when the ratio reaches outside of the normal trading ranges. The end of a bear or bull market usually sees an extreme level coupled with other indicators to give you a weight of evidence. Investors use several financial measures to gauge the market temperament before investing or trading. Put-call ratio is one of those such financial tools which prove useful for investors in more than one way. What is a put-call ratio? The put-call ratio is a measurement that is widely used by investors to gauge the overall mood of the market. A put or put option is the right to sell at a predetermined price. A call or call option is the right to buy an asset at a predetermined price. If traders are buying more puts than call, it signals a rise in bearish sentiment. If they are buying more calls than puts, it suggests they see a bull market ahead. If you look at the current day chart of the 5-day average put-call ratio, we are at extreme greeds. We would love the number to be 1 to 1.5 to do buying, and if the number drops even further, it's a further sign of our warning signals. We like to reiterate the presence of complacency and euphoria in the market. However, this does not necessarily translate into a recommendation to short the market for various reasons not discussed today. Once again, our belief for this year as the indexes will see positive growth, not as significant as last year. We anticipate certain sectors and securities to experience gains, although not as substantial as the previous year. There will be moments of market downturns, and it will not look pretty. But by playing the probabilities and leveraging our stock selection approach, as demonstrated by our track record from last week, last month, to 1 year and 1 month ago, we aim to navigate the market successfully. This year's strategy is reminiscent of 1977. Be selective in your purchases. Remember the catchphrase, study it, analyze it, adapt it. Peace.